Imagine buying a used car that looks perfect only to have it break down a week later. What went wrong? Welcome to the world of information failure, where what you don't know can hurt you and the entire economy. Imagine walking into a market where no one knows the true value of what they're buying or selling. Would you feel confident making a purchase? Probably not. Now, scale that feeling up from a street stall to an entire economy. That's the invisible force of information failure at work. In economics, information is like oxygen. It's invisible, but without it, markets can't breathe. Prices, wages, contracts, and investments all rely on people having the right knowledge at the right time. When that knowledge is incomplete, unequal, or outright misleading, the entire system can tilt off balance. Economists call this phenomena information failure, and it's one of the most overlooked yet critical causes of why markets, which we often assume to be efficient, actually fail. But what does this mean for you and me? Why does it matter if one party knows more than the other in a transaction? As it turns out, the consequences ripple far beyond a single bad deal. They can lead to widespread inefficiency, broken trust, and even full-blown economic crises. In the next section, we'll explore a classic example, the used car market. You might think you're getting a great deal, but what if you're buying a lemon? In 1970, economist George Akerlof published a paper that would go down to win a Nobel Prize, all because of a simple question. It was a powerful one. Why do good used cars disappear from the market? His answer revealed a deep flaw in how markets handle information, and it became one of the most iconic examples of information failures in economics. Akerlof coined the term lemons to describe low-quality used cars. The problem, he argued, isn't just the existence of lemons, it's that buyers can't tell the difference between a lemon and a high-quality car, often called a peach. Since buyers assume there's a chance they're getting a bad car, they're only willing to pay an average price. But here's the twist. Sellers who own good cars won't accept that lowball offer. So they exit the market. What's left? A marketplace flooded with lemons. This concept, known as adverse selection, shows how asymmetric information, where sellers know more than buyers, can cause entire markets to unravel. And it does not stop with cars. Take health insurance, for example. If providers can't accurately assess an individual's health risks, then they may set higher premiums to cover potential losses. But healthy individuals who feel overcharged may opt out. This leaves insurers with only high-risk customers, driving costs even higher. It's a vicious cycle fueled not by bad intentions, but by misleading information or missing information. Akerlof's model cracked open a deeper understanding when trust in information breaks down. Markets don't just perform poorly, they can collapse altogether. Next, we'll explore how this dynamic expands into adverse selection and moral hazard, and why your insurance company might be betting you know something they don't. But before I go on any further, if you're liking what you're hearing, I would greatly appreciate if you drop a like on the video and share it with someone that might benefit from its message, because it is word-of-mouth referrals like this that help to grow Acquired Salary's reach, so I can continue to give you free tools, information, and perspectives you need to live the life that you want. The idea that what you know can hurt me is at the core of two powerful economic concepts, adverse selection and moral hazard. Both emerge from information asymmetry, and both quietly shape everything from the price of your insurance to the stability of financial markets. We already saw adverse selection in used cars and health insurance examples. It occurs when one party in a transaction has more or better information than the other, leading to a lopsided deal. The party with less information can't distinguish between high and low risk choices, so they either overpay or opt out altogether. The result, the market ends up with disproportionately filled with the worst case scenarios, like sick patients overloading insurance pools or risky borrowers flooding loan markets. But what happens after the deal is made? That's where moral hazard kicks in. It describes what happens when someone changes their behavior because they don't bear the full consequences of their actions. Take an insured driver. Once they know damages will be covered, they might drive more recklessly. Or consider a bank that knows it's too big to fail. If it believes it'll be bailed out in a crisis, it might take excessive financial risks and let the public eat the losses. In both cases, the root problem is the same. One party is shielded from risk while the other party is left in the dark and on the hook. Together, adverse selection and moral hazard expose a dangerous reality. Even in well-functioning economies, invisible gaps in knowledge can push people to act in ways that ultimately destabilize the system. We don't have to look far to see how this played out in one of the biggest financial disasters in modern history, the 2008 financial crisis. And this will help us understand why information failure isn't just theory, but survival. If you want to see information failure and how it can wreak havoc on a global scale, look no further than 2008. At the center of it was a toxic stew of complex financial products, misleading information, and a dangerous level of trust in things no one fully understood. Investment banks were packing risky subprime mortgages into mortgage-backed securities and selling them to investors as safe bets. Why? Because credit rating agencies who were supposed to provide reliable, independent assessments were giving these products AAA ratings. Investors didn't have the information, or sometimes the expertise, to dig deeper, so they trusted the labels. Meanwhile, the originators of these loans often had little incentive to verify whether borrowers could actually repay. They already sold off the risk. This was information failure on steroids. Buyers didn't know the true risks, sellers didn't care, and regulators didn't intervene. The result, a housing bubble inflated by ignorance and greed, followed by a collapse that wiped out trillions in wealth and left millions unemployed or homeless. But if it's not Wall Street, information failure hits closer to home too. In the healthcare industry, insurance companies often operate in the dark when setting premiums, which leads to high prices and limited access for patients. In the job market, applicants may oversell their credentials, while employers make flawed hiring decisions based on limited or biased information. Even in everyday online shopping, fake reviews and hidden fees exploit gaps in what consumers know and what sellers don't say. In each case, the lesson is the same. When one side knows more than the other, the system stops working for everyone. How do we fix this? Because while information failure is a major cause of market breakdowns, it's not inevitable. There are solutions, and some of them might surprise you. If information failure is one of the biggest reasons markets break down, then improving information flow is one of the most powerful ways to fix them. Fortunately, economists, businesses, and governments have developed tools to do just that, and many of them are already shaping the way we live and work. One classic solution is signaling, where the informed party voluntarily reveals information to reduce uncertainty. Think of a college degree. It doesn't just show what you learned, it signals to employers that you're capable of completing long-term goals. In finance, companies use audited financial statements to signal credibility to investors. On the flip side, screening is when the less informed party designs ways to extract useful information. For example, insurance companies use health questionnaires or offer different coverage tiers to help identify low-risk customers. Employers use multiple rounds of interviews or work samples to screen candidates more effectively. Then there's regulation, a necessary guardrail in high-stakes markets. Governments require food labeling, product disclosure, financial reporting standards, and truth in advertising laws to help level the information playing field. These rules don't eliminate asymmetry, but they narrow the gap enough for markets to function with more trust and efficiency. Technology is also a growing role. Algorithms now sift through vast sets of data to assess credit risks, detect fraud, and match consumers with better fitting services. Though these come with their own challenges around bias and transparency, ultimately, fixing information failure isn't about knowing everything. It's about building systems that reduce ignorance, reward honesty, and protect those who are at an information disadvantage. Because when information flows freely and fairly, markets don't just work better, they become engines of trust, opportunity, and resilience. What do you think? Please share your thoughts and comments in the comment section below. And if you made it this far into the video, you may as well subscribe to the channel so you don't miss out on future videos just like this one. And while you're at it, consider checking out why Dave Ramsey is out of touch with reality. Until next time, thank you.